Hi everyone, in this course we are going to learn how to identify supply and demand. To be able to identify supply and demand on your charts, you have to know that there are two types of supply and demand. The first type of supply and demand zone is the drop-based drop patterns, as you can see here, or the rally-based rally patterns, as you can see here. These patterns are considered as continuation patterns. Let me break it down for you guys. If a supply or demand zone forms during a trending move, then it's either a drop-based drop in case of a downtrend or a rally-based rally in case of an uptrend. So let's start with the first continuation pattern, which is the rally-based rally. The rally-based rally is a type of demand zone which forms during an up move. A rally is an up move followed by a small consolidation, which is referred to as a base, and followed by another rally which creates the demand zone itself. A rally-based rally will always create a demand zone. They will never create a supply zone. Let me show you a real chart example. This is a rally followed by a small consolidation followed by a rally. This is a rally-based rally demand zone formed in an uptrend market. When the market returns to test this zone, there is a high probability that the market will go up again, because this move is made by a financial institution and other pending orders are still placed there. As you can see, when the market returned to test this zone, prices were rejected obviously. Let me show you another example again. This is another rally-based rally continuation pattern. The market moved strongly up, paused a little bit, and then moved strongly up again, forming a great demand zone. When the market returned to test this zone, we can predict a huge move up because we know that a lot of pending orders are likely to be filled. Let's look at another example. As you can see here, this is a rally followed by a consolidation and another rally that creates the demand zone. A rally-based rally is a continuation pattern that formed during an up move. The first rally is a move up, followed by a small consolidation, and followed by another move up that creates the demand zone. Now let's move to the next continuation pattern, which is the drop-based drop. The drop-based drop is the exact opposite of a rally-based rally, with the only similarity being they both form during trending movements. Whereas a rally-based rally structure will always form a demand zone in an uptrend market, a drop-based drop will always form a supply zone during a downtrend market. A drop is a move down followed by a consolidation, which is referred to as a base, and another move down that creates the supply zone. If the market was to return to this zone, it should push the market lower. Let me give you an example. This is the Euro USA dollars for our chart. The market is trending down, creating a drop-based drop structure that indicates a supply zone. So as you can see, this is a drop, which is a move down followed by a base and another drop down. When the market returns to test this supply zone, there is a high probability that the market will go down again. And that's what happened. When the market reached the supply zone, the market went down. This is another example. A drop followed by a base and a drop. When the market returns to test this supply zone, prices go down. Let me give you another example. This is another daily chart example that shows a clear drop-based drop continuation pattern. So this is the first move down, base or consolidation, followed by another move down. This is the supply zone, and when the market returned to test it, it was obviously rejected. Now let's move to another different demand zone pattern, which is the drop-based rally. The drop-based rally is a structure which always forms a demand zone in the market. This pattern differs from what we've just looked at mainly because of their location in the market. Whereas both rally-based rally and drop-based drop zones only form during trending movements, The drop base rally zone will only be found when the market changes from moving down to moving up. If the market was to return to the drop base rally demand zone, it should push the market in the direction of the rally which created the zone. Let me give you an example. As you can see in this daily chart, this is a clear drop base rally pattern that formed at the end of this downtrend. The drop is a move down, followed by a consolidation, followed by a move up. And this strong move creates a strong demand zone. When the market returns to test it, it will probably go up. So you can draw your demand zone here and enter at the close of this pin bar. Your stop loss is below the zone and your profit target is at the resistance level here. As you can see, this trade opportunity provides us with more than 3-to-1 reward to risk ratio. We will talk about trading strategies in future lessons. Now just focus on how to identify the patterns. Let me give you another example. This is another drop base rally demand zone pattern. As you can see in this daily chart, we have a drop, base, and a rally. You should know that sometimes we can find only one candle that form the base, as in this example. So after drawing the zone, we can wait for a price action setup to form at the zone. As you can see here, we have a nice doji pattern that formed a little bit far from the zone and the market went strongly up. Look at another example. This is another example of a drop, base, rally. As you can see, this is a drop, base, and a rally. Look at this move. This is a very strong move that indicates that a bank or a financial institution placed an order here. So when the market approaches this demand zone, we will see another strong move up. And as you can see, that's what happened. When prices reached the demand zone, the market moved up strongly. On the opposite side of the scale, we have rally-based drop zones. These zones form when the market reverses from moving higher to moving lower. So we have a rally, which is a move up, followed by a consolidation and a move down. A base is a small pause or consolidation. You know, sometimes we can find a supply or a demand pattern without a base. I mean without this small pause or consolidation. But as long as the market makes a move up, then drops, the zone is still considered a rally-based drop, even if a pause or consolidation has not taken place in between the up and down moves. The same thing when it comes to the drop-based rally demand zone. Now let me give you an example of a rally-based drop supply zone. This is the Euro USA dollar daily chart. And this is a clear example of a rally-based drop supply zone. This pattern occurs when the market reverses from moving higher to moving lower. So this is a move up, followed by a base, and followed by a move down. When the market approaches this supply zone, we can predict another move down, and that's what happened. This is a clear doji price action setup that formed at the supply zone and confirmed our entry. Look at another example. This is a USA dollar Canadian dollar daily chart. This is a clear demand zone here. A move up, a base, and a drop. This is a clear supply zone that formed at the end of this uptrend. And as you can see, when the market returns to test this supply zone, we got a nice pin bar that was rejected from the zone. Other tailed bar were rejected to indicate that another move down is going to take place. You know, if you check out your charts, you will find a lot of examples of rally-based drop supply zones or drop-based rally demand zone or rally-based rally or drop-based drop zones. You know, I highly recommend you to open your charts and try to find these patterns, because this exercise will help you better train your eyes on identifying these patterns more easily.